You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-exciting Options Insider Radio Network. If you haven't done so already, listeners, I encourage you to run, not walk, but run to your favorite app store, the Google Play App Store, the iOS App Store, even the Amazon Kindle Fire App Store, and download the old Options Insider Radio Network mobile app. You can, of course, instantly stream all of your favorite episodes of Volatility Views, all 100-plus episodes of this fine program from wherever you have Signal on your device of choice. You can download them for offline listening. If you're going to be traveling, hitting the road in a plane or a train, then queue up some episodes of Vol Views you can listen to when you have no signal. And while you're listening to the show, if you say, I really don't agree with these guys, or I really do agree, or I would love to see them talk about this on an upcoming episode, well, then hit that feedback, hit that commentary tab right there in the app. You can shoot us an email through the app. You can shoot us a Facebook question, a tweet, even leave us a voicemail, all directly through the app. A lot of great ways for you guys to make your voices heard on the old Volatility Views show, just like a few of you are going to do later this episode. And joining me on the old Volatility Views panel, starting off, I think we'll go in order of distance. I'll have to pull out my Google Maps to see which one of you is farther, but I'll just guesstimate and say that it's Maine. So we'll start off with none other than Mr. Andrew Giovinazzi from OptionPit.com. Mr. G, welcome to the program, sir.
It's great to be back. I feel like I've been here before.
I think you may have been. I think you may have been here once or twice.
I feel like it. I don't know. It's got deja vu all over again feeling on me.
Now, I guess it depends where you are in Maine. I'll have to look and see what's farther, you or Jared out there in rural Virginia.
It's hands down me.
Probably is you.
Nothing is farther away from anything in the U.S. than Maine, except maybe the tip of Alaska.
Well, since we mentioned his name, we now have to welcome him onto the show. None other than Mr. Jared Woodard, the researcher extraordinaire over there at BGC Partners. Jared, welcome back to the program, sir.
Thanks for having me. I'm really excited to be here, really just to find out what on earth we're going to talk about. Volatility is dead. I mean, how do we have a show?
You're right. I think we should just cut it off right now. Thanks for coming, listeners. And that'll be this week's episode of Volatility Views. No, actually, there is a lot of interesting stuff to chat about. And to help us do that this week, we have a special guest co-host, Mr. Pat Fay. He is the head of U.S. derivatives over there at Russell Investments. Pat, welcome back to the program. It has been too long.
It has. What, I think it's January was the last time I was on?
I think so. I think the first episode of the relaunched Vol Views was, so it's been about 6 months.
There we are. Yeah. Well, okay. Let's do this every 6 months. You guys do a great job in between.
So we have a lot to catch up with over there at Russell. So without further ado, let's dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. This is, of course, the portion of the show where we break down the week that was from a volatility perspective. We'll kick things off as we are wont to do every week in the old VIX cash, and it wasn't the most active, the most exciting week from a volatility of VIX perspective, but we did have a little bit of a range. VIX actually drifting up a little bit, VIX cash at least drifting up a little bit this week. That is in direct contradiction to the trend we've been seeing over the past few shows where VIX was trending downward. The drumbeat was incessant that indeed VIX was going to mean revert back up into that 20 handle range. People really started wringing their hands when it broke into the 10 handle, and now we saw a bit of a resurgence in the VIX cash this week, trading all the way up into the 12 handle range again. So a little bit of life perhaps squeaking back into the marketplace, though not a heck of a lot. Jared, we'll start there. What was your take on the week that was from a VIX perspective?
Well, we got a little bit of a downward price action in the big indexes this week, and I think everyone was not hoping that would continue, or hoping that we would hold on to that, but wondering at least whether we'd see a meaningful move in realized vol as the most important driver right now. It's been interesting to see how the sentiment and coverage in the press and discussion among traders I talked to has all changed from worry about complacency for most of this year towards people suddenly coming around to this idea that, hey, realized volatility really is this low. I mean, it's incredibly quiet, and until the markets really start to move, there's just no reason to expect implied vol to rise either.
You know, you're right. It is interesting how that just shifted almost on a dime, where people were saying mean revert to 20, VIX has to jump skyward. And then it seems like once it got into that 10 handle range, it kind of broke a lot of people of that estimation. Either that, or they've been listening to this show now for a while and they're starting to realize that what we've been saying is actually coming to pass in the marketplace, that we are lingering at these levels. We're not just going to revert magically back to 20 overnight. And people are actually starting to say the opposite now. We mentioned on last week's episode that people are actually starting to perhaps pontificate that we may actually be seeing a single-digit VIX. So it is interesting. You're right. The VIX mavens out there, the VIX pundits, are a very fickle bunch, and they turn on a dime. And it seems like last week, en masse, a lot of them turned onto the notion that, hey, single-digit VIX, of course, that was enough to give us a little bit of life in volatility this week, and we saw VIX cash actually trending up. So there you go. For all the contrarians out there, you guys get a bonus point this week. Andrew, same question to you, sir. What was your take on the week that was from a volatility perspective?
Let's see. Out of 5 days, we had a one handle range. Oh, no, it was a little more than that. It was 1 3/4. Not much. No, there's no realized vol. When did that happen? It started to happen when the Fed said we're getting out, and now everybody believes them. So I will say this, and I will say it again and again and again. One reason why vol was hanging up at higher levels for so long was the uncertainty around Fed policy. The Fed policy now pretty much, at least from what the market says, is we are getting out, you're on your own, which takes the upside out. When you take out one half of the market, volatility goes to the floor. So right now it's taken out, I would say, the big move on the upside. There's still, the skew is at pretty high levels still right now. I think it's a little bit of a misnomer because you've got such low at the money vol. I mean, you've got 10 delta put is a 14 vol 30 days out. And I mean, just like 4 weeks ago, we had at the money vol was 14. So, I mean, that stuff can only get so cheap. And just nobody wants to sell it. So you should see really high skew at really low vol. So it's a low volatility market, and all those people that are waiting for the VIX to go back to 20 that just started reading their mean reversion textbook, they're going to be sucking on some juice for a while until something actually happens. I keep thinking something might happen out of Iraq, but nobody seems to care. They'll care probably when it spills into Saudi Arabia, but for right now, the militants seem contained, and they probably don't want to attack the Saudis because that's where all their money comes from. So, and that's where we are. We're in a market that's not moving anywhere and going back to whatever the normal was before 2008. And that was like a 9-10 VIX. And in the mid 90s, you were seeing 8-9, really low numbers actually before VIX was a product. So there's nothing wrong with this. It's normal. It just depends how old you are. You just got to be really old to remember that far back.
Speaking of the old school of VIX, Pat, one of the reasons I like to have you on the program, many listeners may not know this, is that you do go back to the early days of the VIX as a tradable product. You were out there in those initial sales calls on behalf of the SIBO, meeting with the fund managers and other people to try to convince them to embrace this, at the time, very, very obtuse product, this implied volatility of the SPX, this thing that seemed like it would be nothing but an institutional layoff product for the SPX crowd and a few others. So a really, really obtuse concept at the time. So I guess, let's start from that and say, what's your take now on how VIX has morphed into just this beast that everyone seems to be familiar with and is talking about in just about every publication under the sun? Did you ever imagine that VIX would reach this level of penetration in the marketplace? And then B, what's your take on what we're seeing right now, this persistent drumbeat, at least until the past week or so, of that VIX is being in this range, this 10 to 12 range is too low? I know when you were early in your career, VIX languished in this levels, theoretically at least, for quite a prolonged period of time. This would have been seen as high to you back in the day. So what's your take on those two issues?
Well, it's interesting. There was an event last night in downtown Chicago, the CBOE's 24-hour trading event, where, as you may know, VIX is now going 24 hours. And it was really something to get all the customers and the SIBO staff and folks in the industry together and to talk about, hey, did you ever think 10 years ago when we were celebrating a 500 contract day in the futures and there were no options, did you ever think that we would be here? Hundreds, millions of contracts a day, and we're now going 24 hours. It was quite an event, quite a memorable experience last night. And going back to that, when we launched the VIX futures in, I think it was March 26, if I remember, 2004, right around then, everybody was telling me, hey, don't worry about it. VIX is ahead. I'm going to make this up, so please don't go check on the historical. But it was around 10, 11, or 12 right in there. It was, don't worry, VIX is mean reverting. Mean reverts to 18. All we need is a little pop, and this product's going to take off. Then VIX went to 10. Don't worry about it, Pat. Don't worry about it. It's going to fly. Then VIX went to 9. I think the VIX, the implied volatility, I think it actually hit around 8 there in April or May of 2004. And that you're right, Mark. It was very interesting to talk to folks. They're like, well, why do I need this product? Come on, volatility's dead, blah blah. Well, all you need is some events. All you need some things happening. Look back to just this year in early February. Take small cap vol, the RVX. Look at what happened to it in March and April, and even continued here in early June versus the VIX. It popped big. So you can never predict it. When it gets this low, all I would say is just keep on the lookout.
I like having you on the show, Pat, because you bring that historical perspective. We've been talking, Andrew and Jared and myself and Mark Sebastian on occasion when he's on, about how so much of the current VIX crowd really came to the product post-2008. So they have this frame of reference that doesn't even really take into account what you're just talking about there, the early days of the product, or even earlier days back when I was in the SPX, and implied vol at these levels would have been seen as being regular. And so there's a huge population out there that has what we would consider, I think, a heavily skewed perception of what volatility should be, and for them is actually quite normal, and they consider us to be the crazies and the freaks. Going back to your point earlier, Andrew, about SPX skew and how crazy things are getting out there. I got an interesting email this morning from our old friend, Mr. Don Schlesinger, my former co-host here on the old program. All of you guys writing in, asking what's going on with Don, what's going on with Don. Well, he still very much is out there, still very much actively listens to the program. He sent in a great email. I won't guess myself because I've already seen the answer, but he writes, if you sell a 10% 3-month out of the money SPX call right now, and you use the proceeds to buy an equal maturity put, so another 3-month put, you want to create a zero cost collar, how far down the put strike chain in terms of percentage terms out of the money do you have to go to be able to get to cover the price of your put, essentially, to get a zero cost collar? What's your guess? How far out of the money do you have to go? Andrew, we'll start with you. You get the first guess.
Actually, we just did this today. It was zero cost collar. It was like only 4 strikes away from the money.
Maybe you're looking at weeklies. He was talking 3 months out, so maybe a little bit.
8 points. So what is that? Like 5%, maybe?
5%
money.
Jared, what's your guess? How far out of the money, sir?
Yeah. I have no idea. Although I think it's going to be a shocking number because I know everyone's been selling the heck out of calls.
Yeah. So if Don writes in, it's going to be a shocking number. Pat, if you want to hazard a guess, feel free.
Let me go 9%.
All right, so you're even more aggressive than Andrew, who said, I think 5%. The answer, at least according to Don, I haven't checked his math, but Don's math usually is pretty good, was 35%. That's how crazy the SPX skew is getting out there right now, both in the call wing and indeed on the put wing. People are really bidding up the heck out of that put wing out there these days, which again feeds into this notion of people hedging, and then therefore the market can rally because they are hedged. I hate to use the C word, but perhaps as a result of being hedged, they are indeed complacent. Cover your ears.
I totally misunderstood that question, by the way.
I know you did. That's why I just kind of kept going. You are of no use to me, sir. All right, moving on here to the VIX options. Of course, a very active product, as Pat alluded to, doing ridiculous volume. ADV coming off a little bit, but still ridiculous. 610,000 contracts a day is just think about that for a second, Pat. When you were out there pushing that and no one wanted to hear anything about it, that it would be averaging, and this would be a low average, 610,000 contracts a day. That's still mind-numbing to me here to hear this all these years later, and I do a show about it every week.
It's unbelievable. I scratch my head, but I also smile because all the smart people in the rooms, they had it. You'd go talk to them, and they had it. They knew this product was going to succeed. It just needed time, and it needed a couple of events. And as you point out, 2008 was really the genesis of it. And for those of us with grayer hair, or should I say even whiter hair, we remember the early 2000s, the 90s, and heck, even some of us remember 1987 in October when the old VIX took way off. These events happen, and that's what get people to wake up and sort of smell the coffee.
Well, all of you out there harping on that call to put ratio out there in VIX, where you're going to be going crazy this week, of course, because it broke back into record territory. It had been drifting off, getting down into the 3.2 or so range, jacking up to 3.6 to 1 this week, which I believe is a historical level. I'll have to check to confirm, but that is certainly deep into the call-heavy territory, which is interesting because usually you would equate that with the VIX continuing to sell off and therefore eliminating even more of those downside strikes from the equation. But in this case, the VIX cash actually rallied a bit this week, and yet the call put got ever heavier, perhaps showing some interest in a VIX spike returning here to the old marketplace. In terms of the active series, we saw their active strikes. The July 16th taking the top spot this week with 414,000 contracts open. They usurped the previous the surprising number one strike last week, which was the July 13 puts, which are still the number 2 spot with 408,000 contracts open. Then we look out to the all July open interest, seems like, on the top slots this week. The July 20s, nearly 400,000 open, 392,000 to be precise. And then the July 17s with 304,000 open. And of course, the strikes that were picking up the most open interest this week, the biggest one was the July 24th, gained about nearly 18,000 contracts in open interest. While the July 20s still topping the leaderboards, but losing actually about 12,000 contracts. So interesting to see what's going on out there in an open interest perspective and an activity perspective out there in VIX options. Moving on to the other side of the VIX realm, the short side, the short duration, I should say, is the VXST options. Still we're still waiting. Like I said, last couple of shows, still waiting for that one to really kick it into high gear. It does seem to be accelerating a little bit every time we check in with it. It seems to be getting a little bit more momentum behind it. Its ADV is creeping up. It was hovering in that 500 level for ages, now hitting over north of 600 for the first time. Open interest also pushing nearly 6,000 contracts, which is pretty high for that name. If you're looking for where the activity is centered out there, you got to look at the 18 calls expiring out there in July 2nd for about nearly 1,500 contracts open, and then the July 20 calls out there, about 1,200 contracts open there. So upside in VXST, not a big surprise given what we typically see going up out there. All right, Pat, now moving on to the Russell side of the VIX equation. Of course, good old RVX. Pat, we've been talking about this a lot every week we check in here on what's cooking over there in RVX. You guys had a huge spike out there in open interest a few weeks ago, about a month ago now, where you saw that big straddle going up, and I believe a very tight upside vertical call spread. Seems like some of that has expired now. Walk us through what's been going on out there in RVX in the last couple of months, and what you've been seeing going up out there.
All right, it's what actually happened. That big trade got put up, and there was actually a couple of them, and then they got taken off here I think it was last Friday on the 20th. So folks traded out of it. They were in the July series, I think the 22s, 26s, 27s. And if you look closely at it, it seems to be timed to differences in the VIX RVX premium. So if you follow RVX, it's always a premium to VIX. And in May, we started to see the premium approach 55%. So RVX was 55% higher than VIX. And then as time went on, it even increased to, I want to say around the 62% in early June, and then dropped significantly in the next week. And then all of a sudden we saw this trade, they closed the trade out. So I would suspect that it went the direction they needed. And it's, in looking at it, it looks like it's a true good customer volume. We've been out talking to folks, and there is a lot of interest in it, especially with small cap vol and the small cap options year to date. You look at the RUT, the Russell 2000 index options, they're up 15% in volume this year. You look at SPX, it's up, about 1% in volume. A lot of activity in the Russell 2000. And in fact, it's heavy in the put wing. If you look at it, the put call ratio or call put, there's 0.3 calls for every put out there. It's a significant difference than the other products. So it's very interesting times. Small caps acting very differently than large caps year to date, and I think that has an effect.
But you're right. We were speculating on the exact same thing when we saw that big volume going up last month in RVX. That was right on the heels of the emergence of that big spread between RVX and the VIX. RVX was really getting a pretty decent premium. That spread was widening out, perhaps beyond where anyone thought it should be. So it opened up a lot of interesting opportunities. That person out there slinging the straddles in RVX and doing a few other trades, clearly looking to take advantage of that. And you're right, they unwound that now. I'd imagine if we do see that disparity emerge again down the road to the extreme that we saw it last month, then I'd imagine a lot of that RVX paper will be flittering in. What are you hearing from the customers that you're talking to and the clients? Is that their primary use case for what they're looking at for RVX right now, is to trade it as some sort of spreadable product against a VIX, or are they looking at it primarily for its own unique use case with the Russell? What's attracting them to the product right now?
Well, I think there's two use cases you just identified. One is an overlay to a small cap portfolio, and I'll talk about that in a second. And then the other one's correlation relative value trading. The hedge funds, proprietary trading type folks, they're far more interested in the relative value trade. And what's piqued their interest in the last year is, if you look at RVX over VIX, the premium last year I think averaged 26%. 27%, somewhere in there. Year to date, it's 38, 39%, popping, as I said, 62, 63 at one point. So that gets people interested, that divergence, the fact that our VIX is not a surrogate for RVX, that large cap vol can't be a surrogate for small cap vol. And then that leads you into the other use, and that's where you get more of the institutional investor interest in it. And that is, and when I want to put a put some protection on my small cap portfolio, much the way folks use VIX for their large cap portfolio. If you used a VIX overlay, a VIX futures, VIX options overlay on your small cap portfolio between March and June this year, you didn't do as good a job as if you would have used the RVX. And the numbers kind of show that. So folks are looking at both of those. I would say that the relative value and the correlation trading is the primary interest right now, but we're getting people interested. We're starting to see folks talk about using RVX as some protection for their small cap portfolio.
Pat, Jared here. I just had one question about related to the future for RVX. I was reading about the acquisition plans by the London Stock Exchange this week, and it just had me thinking whether there was any either announcements or just general intentions on the part of the LSE to do anything with RVX that could take advantage of that connection, or if there's any other plans in that regard.
Well, it's actually very early in the stage, and we're doing business as usual over at Russell while the sale is completed. And there's obviously regulatory approvals and all that need to go on. But obviously, combining FTSE and Russell, right now there's not a FTSE 100 volatility future option. And who knows, maybe there could be. But at this point, we're just continuing on with what we do. Once the sale closes and that, I think there's a lot of creative things that could happen.
Since we're in the land of index vol, before we move on, I want to hit on some of the big stories, the big developments we saw out there in that neck of the woods this past week. There was a big conference here in Chicago this week. Morningstar had their investment conference, and they were talking to Bill Gross, not usually someone you would hear pontificating on volatility, the bond maven, of course, not someone who usually weighs in on this area, but this shows how far and far-reaching volatility has become when even guys like Bill Gross are weighing in and indeed structuring their portfolios around it. He said at the conference, we sell insurance basically against price movements. At PIMCO, that's what we tried in the last 4 or 5 weeks. This wager on low volatility by the $2 trillion asset manager is part and parcel of our new outlook for the next 3 to 5 years, an era they're calling the new neutral. And they're characterizing that by an era of lower interest rates and lower, more stable global growth, and stocks and bonds, in their model, at least their estimation, only returning about 5% and 3% respectively. He went on to say that the firm's money managers all know all parts of the new neutral and incorporate it into their trading. Historically, PIMCO has succeeded in selling volatility, and yes, it's nice that volatility has come down. So even the guys over there at PIMCO putting their money where their mouth is and starting to wager that, hey, despite this drumbeat that we've been talking about on some of our earlier shows, that VIX has to revert, that volatility has to come gushing back into this marketplace in some dramatic fashion, a lot of size money is betting the opposite, including the folks over there at PIMCO. Jared, I know this one caught your eye as well. What's your take on the bond king here weighing in on the big volatility debate and putting some sizable money where his mouth is?
I think this is a huge story, and it's really interesting in a couple different directions. I think the first thing to point out is a friend actually sent me this reference. Apparently, Bill Gross has quite a history in this kind of area. He wrote an article for the Financial Analyst Journal that was, I can't remember the date now, but it was pretty old, actually, a long time ago. And he was writing about the idea of these different risk premiums and that you could write options with an insurance-like mindset in place. And so I think this is something that he's intimately familiar with and has been doing probably for quite a long time. And most of the coverage has been of PIMCO's total return fund. They also have a volatility arbitrage fund that's staffed by a few really smart managers, and they've had some interesting performance over the last few years, and it's a really interesting strategy that they do there in that vol arb specific fund. But it sounds like they've been selling vol across the board in their different products for some time. One thing that I really wanted to note from this article, recent article in the Financial Times, that I think a lot of people missed, it was a quote from one of the junior managers there, or just some deputy manager who pointed out that they had been selling vol last year and this year before everything got deathly quiet, but that they were probably scaled back now a little bit. They weren't taking such aggressive positions now, which I think could serve to quell maybe some of the contrarian takes on this story that Bill Gross is just leaning in too far at the worst possible time and so on. I think, if anything, it sounds like they're taking a little bit more of a prudent approach. That said, I can't I can't really endorse the new neutral thesis. I think there's some demographic tailwinds and some other economic tailwinds that don't leave me all that sympathetic, but it's absolutely something to watch. And I think the way that Gross has been able to do this across asset classes is something that I think a lot of investors could emulate, branching out from just the SPX or Russell 2000 strategies into a lot of different asset classes and strategies.
Somehow I knew that new neutral idea was going to rub you the wrong way.
you gotta, I mean, I don't know. It's a big economic question more than a strategy question, but I think for the purposes of our show, looking at how you can implement a short vol view when it is appropriate, is something, even when PIMCO's doing it, I think that given how large they are, I think it has to inform the way you think about overall market positioning and, which way you want to lean.
Yeah, but look at what PIMCO has for a book, right? They're long like $1 trillion worth of treasuries. They can sell all the juice they want because if we crack up, what's everybody going to buy? Treasuries. So
that's a good point.
I mean, they got it to go. Most of us don't.
Yeah, they got a few bullets.
They got a couple. I mean, I'm sure he's not a stupid guy. It's like now he's going to sell open-ended vol, but they certainly could generate a little bit of premium against a $1 trillion portfolio of treasuries. So, I mean, they could sell the vol on the whole. It doesn't matter to them. I'm just playing devil's advocate here. But if I was Bill Gross, that's what I would do. And I wish I was for like a day.
Just to cash out and be done.
Yeah, just to see what it was like to live in Bill Gross world. I would do that for a day. But if I was him, I'd sell a few VIX call spreads and go for it. He's got them to go.
Indeed, he does. All right, moving on to some of the other volatility classes out here. I know a lot of you guys have been asking about what's going on out there in gold land. We touched on it last week. The metals had quite the surge off what was going on with the Fed and Iraq and everything else. Implied vol, like you mentioned last week, in gold really hitting its nadir earlier in the week and then just skyrocketing afterwards. It was really a tale of two cities from a gold vol perspective last week. This week, the narrative was a little bit more in that one direction. We had a pretty narrow range for the most part, about 12.6 or so to about 13 from a GVZ, an implied vol of GLD range this week. Most of that generally trending downward throughout the week. Once we had that one major spike, it seemed like last week in gold and gold volatility, it seems like ever since then we've kind of just been gently drifting off of that level. Looking at the 10-day vol out there in GLD itself, it's about an 18. 30-day is about a 13. So higher than it was, obviously, but certainly nowhere near the levels it was just a few months back. The 30-day implied right now out there in the product hovering right around 12%. I'm sure, Andrew, you guys out there in the chat room and a lot of your mentees are really interested in what's going on out there in GLD from a vol perspective. So what do you guys focus on over there at the pit these days from a GLD vol perspective?
You know what? The best trade in there has been buying the short-term volatility into the non-farm payroll numbers, the Fed numbers. All that stuff has actually worked out well. You just got to kind of hold on to the straddles. And I'll just say this, it's a high risk trade. You buy a 2-week option, it's decaying like crazy. But, you're only buying them really to hold on to them for a couple of days. If you get the move, you get the move. If not, you're bailing out of it. So they're, I think, into the what we'll call the macro, quote unquote, moves. They've been underpricing the volatility in gold because it's been moving usually like 1.5 standard deviations than what they imply. So as a trade, I think that's been pretty good over the last, in the kind of like the post-Q, we'll call it the post-QE era or the QE era that we've been in. So that's mostly what we're focusing on, not so much buying the long-term vol, but more the short-term vol plays. But with gold volatility this low, you mostly want to err on kind of the buying side and then dump some of the out-of-the-money juice against it. So we've been keeping kind of to that type of trade for the most part.
All right, the other big commodity lighting it up of late from a vol perspective is, of course, oil. Oil and gold kind of moved hand in hand last week from a volatility perspective, and then also kind of drifted in similar patterns this week as well in terms of the big spike and then implied vol coming off a little bit after the initial shock seemed to wear off. We talked on last week's episode about the range that Brent implied vol has had over this past 6 months or so, and how we're still, even with the spike, still on the lower end of that band. Jared, what caught your eye, if anything, this week from an oil vol perspective, in addition to just the continued, seems like coming off of that steep initial spike that we saw last week?
Right. So as Brent and WTI prices have drifted lower, you've seen a leak out in the implied vol over the same period. Overall, I think the levels of implied vol are still pretty elevated, still pricing in a little bit of a added risk premium given all the uncertainty continuing in Iraq and even Syria and just the whole region. So that's a continuation of kind of what we expected the last time we spoke about this. What I think did catch my eye this week was the premium we've seen in some of the energy stocks that wasn't really there before this whole crisis really came to fruition. So just about if you look at for example, components of XLE, the oil ETF, you could pick just about any of those exploration production stocks, and start comparing implieds to realized vols in some of those names, and they're pretty significant premiums that are embedded in there. I have to think that's mostly about Iraq, but that's something that you don't always see on these moves. And I think that if it's time to take a contrarian trade, it might be worth looking at some of those energy stocks, rather than just trying to play the commodity itself.
Andrew, I know you've been watching, kind of speaking on the same trend there that Jared's looking at. You've been playing a lot in the refiners out there over at Option Pit. What have you been seeing out there from a vol perspective in those names?
They had that big pullback. Supposedly we're going to export stuff, and that was going to kill refining margins. And they took all those stocks down a bunch. But the upside curve in the refiners is still what I would call more parabolic shaped, which is not normal for them. So I'm thinking, at least what my personal account is thinking is maybe we get a little bounce back up in some of these things, and maybe some of the call skew might be justified if they bounce back from getting crushed. So they all kind of fell in lockstep, and I think you want to, if anything, if you want to own or put the refiners in your portfolio and sell the upside calls, this is I don't know if you can get a much better time for that kind of stuff right now. So that's the trades that we have been looking at this week ever since they fell off the map.
So covered calls, and sounds like some opportunities for some cheap verticals.
Calls and like ratio call spread, some upside flies, anything where you sell more of the out of the money calls and kind of buy the more at the money stuff, even selling some out of the money puts. It's just, I think, at least the way I read the news, I could be wrong that I don't think this is making whatever this export policy is really a big change. But, the market now just knee jerks so hard when they want to get out of something. So I think there's some pretty decent vol to sell up there in some of these things right now.
Yeah, I think you're right, Andrew. I just pulled up TSO, and I think it's a similar situation there where you've got some pretty good premium in the options, even though the stock isn't really moving in a volatile way. So I would echo that. I think it's a good place to look.
Anytime we get cheap verticals and opportunities for them here, we like it. On this program and anywhere on the network, our listeners are always on the lookout for those. Moving on to the last category here on Vol before we dive into some listener mail. I know we like to talk a lot about domestic, but of course there's been a lot of developments on the international vol front as well. I know, Jared, you have your myriad international volatility trackers that you monitor on a regular basis. But one of the product categories and products that we don't really talk about a lot here on the show, yet to get some traction out there, are the Euro stocks, in particular the symbol, of course, V stocks, listeners. And I know, Pat, you came armed this week with some interesting data on what's been cooking up there in V stocks land.
You look at V stocks, and what's the open interest now? It's about 150,000 contracts, and year to date they're doing about 23,000 contracts a day. And it's interesting, if you look at V stocks versus VIX, that it bounces around differently. Folks think that all vol moves together. We've charted V stocks versus RVX, and it's the average premium, if you will, is zero. It's zero from, say, January 2013 to current, which means either it kind of mean reverts back to being equal. Who knows? Take a look at it. Today it's at 15.5, while RVX was at 17 and VIX was at about 11.5, so falling right in the middle there. We do see folks interested in V stocks versus VIX plays, and now we're starting to talk to folks about a little small cap US versus large cap Europe play. That seems a little different, but some folks have thought that would be interesting. The one thing to keep in mind, though, V stocks is that it's a mini V stocks future, so it's 1/10 the size of VIX. It's a $100 multiplier or 100 multiplier versus the VIX futures and RVX futures being a $1,000 multiplier.
Pat, I was curious on that point you just mentioned about a Russell versus V stocks type of a position, whether you or the company kind of has a view about growth differentials between the U.S. and Europe, or even just between, like you say, small caps in the U.S. and large cap Europe, whether it's growth scenarios or the rates environment that's becoming a little bit differentiated now, and how that might affect that trade.
Interesting question. Of course, I'm on the side of the fence at Russell that's supposed to have no views. I'm not in the investment division. I'm in the index group. But I believe that the growth story for Europe this year was more positive than it has been in quite a few years. So I think that I had heard the CBOE Risk Management Conference back in, I think it was March, I guess it was, that they're starting to see some sector rotation out of U.S. large cap into European large cap. And certainly with the drop in the Russell 2000, I think we were down 9% earlier in the year, and we're now back up in the positive range, up 2%. But small caps are going to be a rockier ride this year. I think that's everybody assumes that and is taking that in stride. But small cap U.S. versus European large cap, I think that the story is still on track for some growth. If not, maybe Europe finally breaks out of it this year and into next.
All right, great stuff, guys. We can keep pontificating for quite some time, but I want to make sure we have some time for the listeners to get their say in on the old show. So without further ado, we're going to roll right on into the Volatility voicemail segment.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options. or facebook.com/theoptionsinsider.
All right, welcome to the Volatility voicemail. Like the man said, this is the portion of the show where you guys get your opportunity to join us here on the old Volatility Views panel. Make your questions, your comments, your ideas known here on the show, just like our first listener did. Goes by the handle One of the Men. I like that. He writes, at Options, is VXX going to collapse into the 4th of July holiday by the July 11th expiration 28 put winner? You can thank me later. It's a freebie. Well, there we go, listeners. If you're out there playing the VXX game, which I know we've discouraged you, tried to dissuade you of many times here on this show, the July 28 put that he's referring to, trading right now for about 50 cents. Andrew, I've washed my hands of VXX a long time ago, but I know you're still knee-deep in the VXX trenches. What do you think of our friend here, One of the Men's freebie pick?
Knee deep in the crapdom of VXX.
Yes.
To be honest, I don't think that's too bad of a pick. However, we had some, we went over some time spreads in the chat this week that worked out pretty well. However, going into next week, you do have the non-farm payroll number. You do get a little bit more of a lift in volatility. So like my thought would be, you buy a time spread and then you close kind of the short end of the time spread before the non-farm payroll number. So that way, if you get a little lift in vol, you've got that decaying put that you can close. And then usually after non-farm payrolls, there's no real reason to have any volatility anymore, and you get that little flush So I don't think it's a bad play. I think you're not going to see any money. That put's going to decay, though, for you pretty hard until, Thursday afternoon or so, Thursday morning till you won't see, what I'll say is you won't see a lot of the theoretical decay on it from the futures until probably, Wednesday afternoon or something. You might start catching a little there, and then it'll probably decay hard on Friday, and maybe with vol coming in a little bit after that. So, but I think you are going to suck on the juice, the decay from now until at least Wednesday. You're going to have 3 days of hand wringing, and then you'll have 1 day of fun.
Suck on the juice. Is that your technical term, sir?
I think that's what we're going to title this segment of Vol Views, Sucking on the Juice.
Vol Views, episode whatever, Suck on the Juice.
But it will work. I think it will work, but I think the time spread would be a little bit better because it's not going to cost him the dough. But it's not as sexy. It's not as sexy as just, wanting the big hit. Nope. When volatility comes tumbling down.
One of the men here clearly into the sexy. That's what he's looking for. So
that's what one of the men.
Here we go. All right. Next up, we have a question from the Atlantan. I'm not sure. Either he's from Atlanta or from a mystical island nation. But Pat, this one's right up your alley, so put your listening ears on. He writes, I find the topic of volatility ETPs and their net impact on volume in the primary products very interesting. When products like VIX futures were conceived, the notion of retail trading these products was inconceivable, to say nothing of retail-oriented VIX products like VXST and others. But it seems like these products are the big drivers of volume these days. I might even go so far as to say they are essential. Do you agree? Is it even possible in the current environment to have a successful volatility future or option without a related ETP providing a steady source of volume? Fun show. I look forward to my weekly dose of all things volatility. Any chance of some ag vol rundowns in future episodes? Well, I'll start at the end and work my way back. The ag stuff, we have hit on that before in the shows, listeners. There has been a little bit of development in corn of late, but not a whole heck of a lot of vol to be exhibited out there that we can really dive into. But if something big happens out in the ag vol space, we'll certainly hit on it. As you see already, we can fill up the whole show just with the product categories we touch on now. It could be a 2-hour show at this point, but we certainly will keep an eye on the ags. I know quite a few of you are diving into those these days, in addition to the metals and the energy products. So we'll keep an eye on those, and if something big happens out there, something interesting with the term structure, the skew, we'll be sure to parse it here on the program. Now, for the first part of his question, Pat, I think this is pretty interesting. There's actually probably a pretty savvy listener out there who's been watching the vol space for a while, and it's actually an interesting question. It's something you probably deal with on a day-to-day level. You're out there right now beating the drum, getting the volume going for a brand new VIX-related product, the RVX, and there are no ETPs on it right now. So maybe you can explain to our friend the Atlantan, what is your take on this? Do you think it's necessary to have an ETP to really drive volume in this marketplace, or can a product succeed on its own? And if it is, if that is your view, is that pretty much where the focus of your efforts is these days? In addition to getting liquidity providers and all the other stuff, is your primary focus really on getting an ETP for RVX?
Well, let's take that first one. Definitely, we're interested in getting an ETP for RVX. Have been talking with a number of the structured product providers, and I'll say there is interest in it. Obviously, you want to see a little liquidity in the options and futures, and you want to see some volume and open interest there. But if we look over to V stocks and kind of take that as an example, it did start to become much more active when the ETN was issued, and it didn't require a lot of volume to get it going. I think that maybe it was 1,000, 1,500 contracts a day in the futures, which if you compare that to VIX, it's about 120 contracts a day, the 1/10 the size. So we're definitely interested in it. We are hoping that the VIX futures and VIX options volume picks up. Certainly the interest levels that we've seen in the last 2 months are helping us get there. Let's take the necessity question. That's a good one. Not quite a chicken and egg example, but if we look back to 2008, one has to ask themselves, was it the ETP, the VXX? Was it the huge volatility spike in the financial crisis? Hard to separate out cause and effect there. No doubt, absolutely no doubt that VXX drives huge volumes into the VIX products. and that's a good thing because that activity is predictable. You know it's coming in there, and folks love to trade against it. They love to anticipate things. So that absolutely helps the product. To go so far as it's a necessity, that I wouldn't want to opine on that one. Let's just say that it's something that makes the product extremely strong and viable. And obviously that's why we're interested in it as well.
Definitely a much stronger part of the equation than probably anybody ever anticipated back when these products were first being conceptualized over there in SIBO land. Great question there, Mr. or Mrs. Atlantan. And last up, we have one, could be from an international listener, I can't tell. It doesn't say where he's from here, but just drawing from his name, I'm going to guess he's from overseas. This is from Giuseppe Verino. He writes, to what do you attribute the recent vol divergence between the VIX and the Russell 2000? It seems as though Russell vol was unjustifiably inflated. Or do you feel this premium was justified? Do you expect this scenario to reemerge anytime soon, or was this a relatively one-off situation? Jared, hadn't heard from you in a little bit. I know you were watching this spread with great interest. What was your take on that spread? Did you think it was unjustified, the premium levels we were seeing in RVX, and do you think we'll be seeing it again anytime soon?
Yeah, that was an interesting period. I think that given the move in the underlying, it's hard to say that the spread wasn't justified. But in terms of future expectations, I think it's going to depend really entirely on what kind of growth environment we see in the near term, whether you see investors kind of ratchet up their risk appetites again, or kind of get risk averse as data comes in, and especially with overall nominal volatility levels this low, I think that there's just a lot of that the kind of upside gamma, that upside elasticity, if we do get a shock of any kind. So if we do get a negative surprise, I think we could expect to see a similar reaction. But again, it's really going to depend entirely, I think, on the fundamental data.
We actually had some clients trading Russell butterflies, and the realized vol in there was like twice the S&P 500. So we think it was justified, but our joke was like every time we put a Russell fly on, it just rips our face off. Like it doesn't move, and then we have a fly that looks priced okay, and then the Russell moves like 1.5%, like bang, like right after you put it on. So I think from some hard experience with the Russell, we tried that actual ARB worked decently, where we would sell like Russell Iron Condors and buy SPY at the money options. That actually worked pretty decently as long as you went far enough away, because anything at the money, you're just getting gobbled up in for a while. So it was there, it was real, and now it seems to be subsiding somewhat. That's all I'll say on that subject.
The old rip your face off butterfly, another technical term from Mr.
Exactly.
Andrew.
And actually, when some of our clients, I go, just tell me when you put that on, because I want to know, because I want to get set for the next move. Not a very nice thing to tell to a client.
Way to fade your own clients there.
I know. Well, what are you going to do? It's all for one and one for all, ultimately, when you come down to it. Just let me know when you're putting.
That's a key to customer retention right there. Fade them.
Fade them all
day.
I have some winners myself, so they like me to tell them when I'm doing something. Usually when I close something is always a good time to get in, because there's always more to it after I leave it.
All right, Pat, take us home here. I know this divergence was a big driver for you guys. Saw some sizable volume out in RVX as a result. What do you have to say here for our friend, Mr. Verino?
Well, definitely there's been a difference. I mean, you see as I mentioned earlier, the last year the premium averaged around 27%, and it spiked to 63. I think it hit 63 on June 10th. And as Andrew says, I mean, you got to be careful here. I mean, the small caps do whip around more, and that's why RVX has always been higher than VIX. And small caps are more volatile. That's why there's a premium, and that's why that there's going to be a difference. And in the year to date, small caps have been much more volatile than large cap stocks. And take today. I mean, the S&P 500 was down maybe 0.1, 0.2, while the Russell was up almost 1%. So there's going to be a premium. The question is what's the difference, and can you do something with it, and do something without, as Andrew says, getting your face ripped off.
I like it. Unfortunately, that's all the time we have for this episode of Volatility Views. But before we go, as always, I'd like to check in with each of my panelists here to see what they have cooking that may interest you, listeners. Until the next time, we can all gather together here around the old Volatility Views panel. And Pat, since you're our guest co-host this week, you get pride of place. A lot of stuff cooking in your neck of the woods over there at Russell, so I'm not sure how much of a tease you can leave us with, but whatever you can share with us, whatever hints that are coming down the pike from Russell you want to leave with our listeners, the floor is yours.
Well, in addition to ordering bangers and mash on a regular basis now.
Yeah, you're going to be a London boy now.
You hit it on the head. We're probably going to have to be quiet for a while, and then obviously this will take some time to complete. But we're looking at a few new products and talking with our exchange partners. But I think the next couple of weeks at least are going to be pretty quiet.
I will say this, you guys weren't in play for very long. It wasn't that long ago when I saw you a few months back and the rumors were just trickling out that Russell may be on the block, and then bam, a few months later, it's already gobbled up. So I guess that's a good sign, right?
I guess. I saw one of the analysts called us, best of breed. So, we like to think that. We like to think that we're cut above. So it's nice to hear.
And London has some skin in the derivatives game, so they may be willing to dive even more deeply into the Russell derivatives area, which of course is your purview over there, and of course ours as well.
You're right.
All right, I won't pull you any farther into the deep waters, Pat. Don't worry. All right, and Mr. Andrew, what's coming down the pike over there at the pit?
Unfortunately, when everybody hears this, the webinar will be over. But we do have a webinar this weekend on Saturday on trade and portfolio management for option traders. It's a good one. Run over to optionpit.com/events. You can buy the recorded version. You don't get it live, so it's not as cool and sexy as the live one, but you do get the recorded version if you're interested. So let us know. Generally, our webinars that we've been selling them out, so it's a good thing. And but we'll be this weekend on portfolio and position management.
And if you sign up for that now, listeners, you'll get that free indicator from Andrew when he's getting his face ripped off by some butterflies. So you can trade around those as well. Very valuable information there.
Exactly. You don't get a tell like that very often. It's like the sheet coming into the SPX. You don't get those kind of customers very often anymore.
All right, wrap us up here, Jared. What's coming down the pike over there at BGC Partners?
So the much mentioned, at least by me, single stock scanner publication that I've been working on is just about ready. We're looking at some things that most people don't and are hard to suss out of the markets. So I'm really excited about that. Still coming out with our volatility tracker every couple of weeks, as well as some pretty cool, I think, individual ideas that the team has come up with over the past few weeks. So that's all working really well.
I like it. As long as you're beating the drum out there, Jared, people will be interested. Good stuff. We'll be sure to, if they want to check it out, listeners, surf on over to bgcpartners.com and check it out for yourself. All right. And on behalf of Jared and Andrew and Pat, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the program, and of course for sending in such great questions. Keep them coming, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.